You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it is Education Wednesday. Means it's time once again for Options Playbook Radio, the program for you out there, the busy and quite active these days retail stock trader. Maybe you're dipping your toes into the options waters for those first time. Maybe you've been doing it for a little bit. You're one of the many millions who joined the options market for the first time in 2020, and you want to learn maybe how to trade those things a little bit better with some offensive and defensive plays you can utilize in your own portfolios. Either way, we got you covered. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever exciting, at least we hope so, Options Insider Radio Network. If you're listening and you're saying, wait a minute, that's not the right guy for this show, you are correct. So allow me to introduce your usual host, aka the options guy, aka Mr. Brian Overby, aka the senior options analyst over there at Ally Invest. Mr. Overby, welcome back to your own show on this rare live huddle edition, sir. Welcome.
Well, it's great to be here, Mark, and I really appreciate you taking the time to put some listener questions together. And we get this chance, this opportunity so infrequently that I really appreciate when we do get the chance to actually answer some of these questions. So let's take the time and let's huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody. We got quite a few questions coming in. Let's kick it off, as we like to do in these troubled times, with a little bit of love. This came in on our last huddle, which was about a month and change ago. It's been a while since we've done this, Brian. This came in on YouTube from Run the Race Mark. And he or she just said, very helpful discussion. Thank you. Well, you're welcome there, Run the Race Mark. And a lot of you are starting to get the show over there on YouTube as well. Hey, wherever you want to get it. I know Amazon Music added it not too long ago. A bunch of new outlets are picking us up. As new outlets come online in this crazy thing called podcasting, we usually add them. So we're pretty much available on any platform you want out there, Spotify, Podbean, you name it. So in the app stores as well. So wherever you get it, glad you're liking it there. Run the Race Mark. Keep those questions and comments coming too. We do love to hear from you guys. And Brian, since it's been a little bit since we've done this, we'll start you off easy. We'll go light. We'll start you off with a question where our audience just finished debating. We put it out to them earlier this week, late last week. It was about the kind of a topic du jour that's been going around the markets of late. I haven't had a chance to get your thoughts on this, but our question was, there have been many debacles that left lasting impacts on the options market. 87 crash, long-term capital, .com crash, great financial crisis, so on and so forth. the question we have for you is, should we add the GameStop frenzy and all the resulting brouhaha to that list? And it started off, Brian, very hot and heavy in the yes category. Our audience voting it's a post-GameStop world. As the poll went on for a few days, we saw more no's, it's a tempest in a teapot coming in. And they end up being pretty much 50-50, about 54% saying yes, we're living in a post-GameStop world, and no, it's a tempest in the teapot. I'm curious, Brian, it's the first time you and I have had a chance to really chat here in the new year since all of this madness came out. And I'm curious, just from a 10,000-foot perspective, what are your thoughts on the lasting or perhaps not lasting impacts of all this furor over GameStop, sir?
Well, one thing that I just looked at, and I actually had been talking a little bit about this with clients today, is that I don't know if it's over with yet. If you look at the options contracts, they're leaning towards not, in that we still have like a lot of weird, I actually called it crazy math that you're seeing on a lot of these contracts. Actually, today, somebody sold an 800 strike option contract for 2 cents. The trade went off. So like, you're just like, what, 800 strike? Like, really? I didn't even know they opened those. And just a lot of things like that, like looking at going out. What was the strike I was looking at? Going out 30 days all the way out to the 300 strike, with 30 days remaining. And you're still looking to get $1.50 for that option contract overall. So just the premium and the skew and everything is just all over the place on the options on the options marketplace. Now the rebates came in a little bit. There's a lot of people that a few of the people that have came to their senses and stopped shorting it. It still is a little bit heavily shorted, but not like it was when the big run up, which caused the big run up to happen. So I would definitely put it in there. As far as the options market, the only time I've seen skewing like this was, way back in 2007, 2008, when the financial companies were struggling, and you're seeing this type of skew to the downside in the put option contracts. But now we're actually seeing it to the upside on the call option. So, yeah, definitely a case study without a doubt. And there are other stocks, not just GameStop. AMC, it still has that type of skew, and a few of the others.
Yeah, that impact, shall we say, certainly spread to a lot of other names. I voted more in the yes category. I think we haven't heard the last of this. We know Congress these days likes to get their pound of flesh, and they're probably going to get it out of this one. And if you've been around the option space for a while, these headline-making debacles usually tend to have lasting and usually unanticipated regulatory impacts down the road. So I don't think we've heard the last of this one. So file me in the yes category there. If I do hope the answer is no. That's where my heart is, but my head says unfortunately yes. So let's go to some of the live questions now. Again, a rare live opportunity to ask Mr. Overby whatever is burning up your options brain there. Remember, we bump the live people usually to the top of the list. We like all you sending in after the fact questions too. We cherish all of you. But if you listen live, you get bumped up, just like Mr. Unlimited here, saying Brian and Mark, if it's both of you today. Yes, it is both of us today. He says, what tool do you use to have something like the Eye of Sauron, or something that you could see contracts being sold in real time? If you're wondering what he's referring to, listeners, that's what I jokingly refer to our scanning system for our unusual activity that we highlight for our odd block segment of our option block show that we do twice a week here on the network. A popular, fun segment. It's been going for a long time. Nigh on 10 years. So when I give you my tools, you may be like, oh, that's interesting. But we've been doing it for a long time. So we had access very early on to some early tools, like, for example, Live Vol, when it was in the early stages, before it was really, certainly before it was part of the SIBO, but also when it was really, before it was really available to the masses, and we were able to help tweak and help build that platform a little bit. Same thing with Trade Alert. We were very early users and adopters of that platform. So as a result, we built up some workflow around those platforms that we tend to still use a lot these days. It's just, once you develop the pattern, these software is stuff that's designed for what we do, pro grade. It's not just kind of a basic kind of retail oriented scanning tool. And it allows us to do certain criteria. Like, for example, something basic people don't think about when they're scanning for unusual activity, but it's putting in the filter there that you want opening. for our purposes, we don't really care about closing trades. If someone put on a 10,000 lot of covered calls and now they're taking them off, good for them. But that's not what we're here to talk about on our shows. We're looking for opening content. So little nuggets like that these higher end platforms give you that a lot of your basic, let's say, covered call screening platforms and things don't really give you. So those kind of criteria, things that are high volume compared to what they've traded in the past, all sorts of other filters that we've built up over time. So the core were those two. And then we play with other platforms every now and then as well to try to filter in different use cases, different needs. But we have it down so reliably now with those kind of couple of core platforms now that's what we like to use. Unfortunately for you guys, those are both paid platforms. So that's why I'm loath to recommend them to everybody out there. We are starting to play and look around. There are different retail offerings offer different types of scanning tools. Some are better than others. What I've been talking about and behind the scenes and thinking about doing for a while there is maybe putting together a list of some of our favorite freely available scanning tools that you guys can utilize to approximate some of this functionality for yourselves. So we're working on that, Mr. Unlimited, everyone else who has a similar question. So maybe stay tuned for that. But right now, the best are unfortunately still the paid platforms, the Live Vols and the Trade Alert. Trade Alert does have a cheaper what's trading retail-oriented platform. It's not going to be as in-depth, but I think that's about $99 a month. So that one may be able to get you most of the way there. So try out that one at the very least and see what you have going. Brian, I know you guys do a lot of different things over there on the Ally website. I know you don't do a lot with unusual activity, but I'm curious for you if there's any tools or functionality over there at Ally you want to recommend. Have at it, sir.
Well, yeah, the tools that we have are just a little bit more basic, like a profit and loss calculator, probability calculator, not something that's actually searching for the volume. It's always interesting to see, as usual with large volume trades, you got to follow the flow, and you can't always be 100% sure that just because somebody put a lot of money in it means that they're going to be right. So that's just comes with a word of warning, but it is definitely worth looking at. And I do agree with that. And it would be nice to be able to see that type of information overall.
One of the ones I'm looking at doing, and you guys can maybe play out yourselves, there's not a lot of platforms that do a good bit of skew analysis. And that's one I think is really informative, particularly if what we're talking about right now, these, shall we say, heavily shorted, these frenzy names. When they start bidding up the out of the money call skew, that, or could be a put skew in different names if they're looking to go to the dark side. That's something that's, I think, worthy of note. Not a lot of platforms still do a very good job of that. I can say, hey, I want to have X delta out of the money calls versus at the money calls. I want to look at that call skew range, and I want biggest changes in call skew 30 day, 60 day, 9 day, whatever it is over the last trading day, last week, whatever it is. And that's something I'm looking to configure as well. Because I think there's a lot of value, particularly right now, in a scan like that. And I don't see a lot of platforms that really make that easy to do yet. So we may have to end up cobbling together our own. So stay tuned on that front as well. I'm kind of working on a lot of fun stuff these days behind the scenes. All right, let's keep on rolling. Great questions there. Well, this one's an easy one, Brian. Comes from Joseph Culp. He's talking about the name everyone has on the tip of their tongues these days, which is pretty much any given day in the options market. We're talking all these crazy shorted names and everything else, but it's still Apple. It's still the big dog. It's still the king of the roost. It trumps Tesla, trumps everything else pretty much 99.9% of the time. And Joseph Culp wants to know, Apple call to put ratio is 3-1. What the heck does that mean? I've never been the biggest fan of put to call ratios. Maybe let's start there, Brian. Are you a fan of put to call ratios? I think they're kind of overhyped for what they are. And then B, maybe if you want to give Mr. Culp and anyone else out there who's confused about what the heck we're talking about, what the heck is a put to call ratio, sir?
Right. Overall, bottom line is I agree with you, because the biggest thing about a put to call ratio is in the options trading world, you never know if by just generic numbers like this, if people are coming in and buying the puts, or if they're selling the calls, or selling the puts, or buying the calls. You just don't know exactly how that order came in. I know what they're trying to achieve by the put to call ratio. They're trying to say that if there is more volume in puts than in calls, you're going to have a positive number. And when you have a positive number, that just means that there's more volume in puts than calls. So by that rationale, if everybody's trading puts, you'd think that maybe that's a more bearish indicator. But once again, you never really know how that order came to the marketplace, where if they sold the put, they're bullish. If that order came to the trading floor that way. So I actually just looked at Apple right now, put call ratio, and it's actually now 0.42. That means that more calls were trading than puts. If you get a number above 1, that means there's more puts trading than calls. Now, a lot of the financial networks just like to post it, but it's more so just an interesting little tidbit. You can't really put a lot of weight behind it as to if it's a bullish or bearish sign. But if it gets way out of whack, well, then I think it becomes a little bit more interesting if you see the put call ratio on the put side, let's say really high, like approaching 2. Well, then there is definitely a ton of put volume coming in. So on the extremes, it's more interesting than in the middle. But then again, like I said, don't really know what the volume is as it comes to the floor.
Yeah, that's why I tend not to shine a lot of light on it. Though in some of these names we're just talking about, some of these heavily crazy meme names, and Apple certainly falls in a very popular category as well. You can probably intuit that a lot of that paper, especially if it's coming in hot and furious, is usually upside call love. People are buying these things because that's kind of the way they tend to trade names like Apple and these heavily shorted names. So certain names you could put a little bit more faith in it than others. But yeah, I'm with Brian. I'm not a huge fan of call, but people put it out there as like if it's the keys to the kingdom, when in reality it's an interesting flag maybe, but not much more than that. All right, let's keep on rolling. Ella, Brian, or I should say confused Ella, as she puts herself, has a question about your favorite strategy, or perhaps maybe this is more of your second favorite strategy. I probably would put the skip strike butterfly as probably your number 1 favorite, but I think the fig leaf is a close number 2, and that's what she's asking questions about. She says, hello. Well, hello, Ella. I love my weekly dose of OPR. I find the fig leaf strategy fascinating, even though I'm with Mark and lukewarm on the name. Yeah, the name is kind of a fun one. I've given Brian a hard time about that in the past. She goes on to write, I'm still pretty new and I'm confused about the structure. So let's say I put on a F, I'm assuming she means a forward fig leaf with a 6-month 85 delta in the money calls. Remember, fig leaf listeners is kind of like a stock replacement strategy with a quasi covered call component. So she's going to be buying this very in the money call on Ford. Then she says, then I write a weekly 10% out of the money calls against it. Will my broker view those as offsetting positions, or will I be margined for a naked short call? Also, how do the mechanics of this trade work? If I get busy, which happens, you get busy with life. If I get busy and Ford goes through my out of the money call strike, what happens? Will my account then go short Ford from that strike? Are my long in the money calls automatically assigned to cover that short position? Or would my account effectively have a short stock and a long in the money call position at the same time? Thanks so much. Confused Ella. Well, Brian, it sounds like Ella here has questions about kind of the behind the scenes mechanics of your second favorite strategy, the fig leaf. What do you have to say here for confused Ella who wants to do fig leafs in Ford, sir?
All right. Well, a lot of the questions are perfect. Exactly questions that you should be asking. So really what a fig leaf is, it's a diagonal spread. There is no additional margin requirement as long as the option that you're selling has a shorter expiration than the one that you are buying. So with that said, it looks a lot like a covered call in that scenario, except for you're paying less for the underlying by buying the option contract. It doesn't move exactly like this stock because it has a high delta, but not the delta that you would be buying is not 1 overall. And when I sell that call option against it, the concerns are when it becomes in the money. So inside the options playbook, we have a section that's called how we roll. And one of the things that if you're doing this strategy, you're not doing it to sell the stock. You really are hoping that option contract's going to expire worthless. Now, one of the benefits is if I'm selling it against an option position, like even bringing in 30, 40 cents is interesting in that I didn't pay as much for the stock. So a lot of times 30 or 40 cents is a fairly decent percentage of the actual long option contract. I say that because I would rather err to the side of going further out of the money and getting less premium than I might if I'm doing an actual covered call on 100 shares of Ford stock. So if it does go through my strike and I do fall asleep, yeah, then you kind of have a situation in that. I own an option contract that gives me a right to buy the stock, but I do not own the stock. So you want to make sure you have an alert. You want to try to avoid that assignment. Simple thing you can do is just close out of the entire position if you'd like to, or you could buy back the short option, or you could roll that option contract. But if you let yourself get assigned and that situation, you do have an issue. Now, hopefully your broker will give you a call and say, hey, what do you want to do? You can either go out and buy the stock and give that as the assignment, or do you want to exercise your long call option? Most of the time, you don't want to exercise that long call option. And the reason why is that it might have some time premium in it. And if you exercise it, you don't capture that time premium. So in a scenario where you just want to get out of the position, but you fell asleep, what you probably want to do, you get the assignment notice, you go out, buy the stock, give it for that person that wanted it because they exercised their call, and then sell your leap option and get out of the position. That's the ideal situation if you fall asleep. But if you're doing this trade, you need to not fall asleep. It's that simple. Or else, especially in a company like Ford, which is right now an $11 stock, I'd rather just go on out and buy the stock in that scenario. And then you don't have to worry so much about it.
Yeah, that's a good one for when it's cheaper. What about her first part of her question, Brian? Because that's an interesting one, too.
Okay.
People get hung up on that as well, because that's why we call it the fig leaf, right? It's you only partially covered. If you have the stock and you sell the covered call, obviously your broker's going to treat that as two offsetting effectively transactions. If you get through your short strike, they're going to take your stock away. Obviously, as you mentioned, the call, not quite the same thing. So from like a broker's perspective, like an ally, do they view, like in her example, she does a weekly covered call, or a short call, I should say, and then the long in the money call farther out. Do they view that as offsetting, or will she be margined pretty heavily for that short call?
No, it's offsetting. I think I mentioned it a little bit, but yeah, it is offsetting. It's considered a diagonal trade. So you would, as long as you are buying the longer dated option and selling the shorter dated option, that will be considered covered, mainly because the option contract that you're buying will be deeper in the money, and you'll have the right to buy it at a lower price than the obligation to have it called away from you at the higher price.
Yeah, those are always important things to touch on, because they can be stumbling blocks for a lot of people when they think about this strategy. And this sounds cool, but wait a minute, I don't really have the stock. I have this thing that's like the stock, and what does that mean? So these are good questions. Confused, Ella. Hopefully you're not as confused. Now, another kind of broker / margin related question here, Brian. You get all the fun ones. This comes from Jason Cruz. Jason wants to know, I was listening to an earlier show on short credit spread assignments. I asked my broker some assignment questions, and with lower margin available, they mentioned a, quote, Fed call possibility. Any chance you guys could give more detail on what that means? Same as a margin call. Well, if he's talking about Fed call, the term we always bandy about, and used to for a while anyway, was, of course, the Fed put there, Jason. That's, of course, the notion that at a certain point, if the markets sell off too aggressively, the Fed will step in, as they did last year in March, with some sort of easing program that will effectively bolster the market and provide some sort of floor at that level and act to all intents and purposes like if the market had a put, the Fed had a put there on the market, and kind of help bolster and hedge it there at that level. So that's the most common vernacular out there, Fed and puts. Fed call, a different beast there, not quite the same thing as a margin call. Brian, a Fed call?
Yeah, the difference is it's upfront in that when you're doing a margin call, you're trading on margin. The price of the stocks that are in your margin account are fluctuating. And when you get a margin call, that's a bad thing because the market has gone against you. A Fed call, the main difference is that that's the initial requirement if you're buying it on margin. In that if I go out and I'm buying 100 shares of stock, and the stock's trading at $50, I need to have at least $25 in my account on an initial brokerage account. I'm making the math real simple here. So the Fed call means that you got to come up with at least 50% of the cash in order to buy the stock initially. And then after it trades, if it goes against you, that would be considered a margin call.
There you go. See, unmasking and unraveling the mysteries of broker vernacular and margin fun. Margin isn't always the sexiest of things, but as we saw recently with the GameStop and Robinhood and IB and TD fiascos out there and the issues with messaging and everything else, these things become very important very quickly. So it's a good one. Good question there, Jason Cruz. All right, next up, 4Gen. 4Gen wants to know, this is kind of a long-standing, interesting debate going on in the markets, Brian. He wants to get your thoughts on it. He says, what is better protection against a major sell-off right now? A 5% out-of-the-money VIX call or a 5% out-of-the-money SPY put? It's the old standby of pick your poison, SPX or SPY put versus some portion of VIX upside trade. So, Brian, I guess because he puts it as protection, that makes it a little bit different than he's just saying, hey, well, let's just roll the dice for some crazy money on a sell-off right now. But I'm curious for your perspective, since he says, what is better protection against a major sell-off? What is your choice, the 5% out of the money VIX call or the 5% out of the money SPY put?
Well, the SPY put is a easier trade overall in that you can have a downturn and that runs the VIX call options up usually, right? Usually have an inverse relationship to where the markets are at. But then it's a real tough call to decide when you're going to get out. So let's say the markets were to make a 5% down move overall, since you're using that number. The VIX would spike more than likely. But then what if it's followed by another 5% down move the next week, right? When are you going to get out of that VIX option contract? And if you don't, you risk the fact that you're going to get a little normalcy comes back in the marketplace. And then you have the situation where the VIXs came back and that opportunity is lost. So overall, the easiest one to do is the SPY put, in that if the market's down and everything settles down, well, I can still get out of that put. I don't have to pick that timing so perfectly like you do with the VIX option contracts. But then there's cost, everything else that's involved with it too. You got a little bit more expensive underlying overall, and then you got volatility involved. But if I had to choose, I guess I would go with the SPY option contract because I think it's just a simpler trade to understand and actually use it what it's made for, which is protection.
Yeah, I'm with you on that. Because he says protection, I definitely want to go with SPY. Because SPY is, you have a contractually obligated thing. It has a delta time. You know what you're going to get with SPY. In a major sell-off, you're going to get this amount. You're going to be stopped out at that strike. It's nice. With VIX, it's very much a crapshoot. It could very well, and it very well might outperform in an aggressive March-style sell-off. VIX is going to explode again. Look what happened back in March, right? It soared north of 80 in those levels. So in that very, very near-term time frame, as Brian mentioned, it's going to do really well, but you got to get the heck out of Dodge really quick. And it's not really, I don't call it protection. I don't call it a hedge. It's much more of a speculative type trade. If you want a hedge, if you want protection, you have to go with the contractually obligated inverse correlation the SPY put brings you. Because if you have a gentle sell-off, then you're not going to get any bang for that VIX call. Meanwhile, the SPY put, it's going to get you something. If you go through that strike, you know exactly what you're getting. If it's a gentle split, VIX could do nothing. It could be a whimper. So that's why I have a hard time banking on it. If you want to do some speculative trading and you think a big sell-off is coming, you want to get that big pop, yeah, VIX calls are going to do it. But don't think of them as this great portfolio hedging tool. It's not really what they were designed for. All right. People like to send in the epic treatises, Brian. So maybe we'll close out on this one. Maybe got some more time. Maybe do a couple more, but this is a long list. Comes from Jeff Davis. I must make sure I pronounce his name correctly. Jeff. Easy one, Jeff. This is, hey, options insiders. I have a cautionary tale about exercising put options. Here's the story. Last Thursday, I decided, what the heck, and bought a one-lot put at $65 on GameStop. The bubbles seemed to be popping, and I figured it'd be a fun and responsible way to play that casino without too much on the table while limiting my downside risk. Toward the end of trading on a very rocky Friday, I found myself watching the stock bounce around in the low 60s, with my put barely in the money. Ordinarily, I'd have shrugged my shoulders and closed out for what little premium was left. In this case, however, there was a fair chance such a volatile stock could drop even in the last couple of minutes of trading, vastly improving my position. So I held on through market close, and the option auto-exercised just in the money. Oh, I see where this is going. I did not actually own any shares of GameStop, though I did have adequate funds to purchase them. My understanding of exercise put options is that the brokerage would secure shares on my behalf, put them to someone else's account at that strike price, and hand me the difference in cash. Yeah, that's unfortunately not how it works, Jeff. He goes on to he says, imagine my surprise when, before going to bed, very early Monday morning, I saw on the Toss app, still had my game position open, marking it anew with a loss of hundreds of dollars. Game was now trading in the low 70s. I looked closer, saw the little red 100, and realized I was now short 100 shares of GameStop. Yes, that's how it works. Fortunately, I was able to close out at some point before market trading to eliminate that risk, but I did eat the net loss. If I had bought a higher count of puts, if I had bought a higher lot count, and or if GameStop had spiked severely early Monday before I could take action, this could have turned out a lot worse. I'm wondering if you guys could elaborate on exactly how brokerages implement the exercise of put options when you don't own the underlying. Specifically, how is this implementation affected by market conditions and brokerage policy? And what, if anything, can traders do to establish their exercise preferences with their brokerage? I hope this proves helpful to others. Yours, Jeff Davis. Yeah, Jeff, I think this will be helpful to others. It's probably a lot of people out there who have that same misperception. Remember, at the end of the day, calls and puts, they're very clear on what they want you to do. The call is your right, but not the obligation to buy an underlying by a particular date and price and all that fun stuff. The put is the right, but not obligation. Of course, if it goes in the money, which is what happened to you, then it's going to be auto exercised. And once it's auto exercised, yeah, it's not some sort of cash settled index where you're getting some sort of differential between the strikes. You're getting the short position. You have agreed to sell that now, and you've allowed it to be exercised, which in this case means you want to get short 100 shares of GameStop at 65, which we all know in this day and age is an extremely risky position. The stock could move up and move down. The one thing you never want to have happen in any of these environments is come in on Monday morning with unanticipated positions, unanticipated risk in your brokerage account. That's a very unpleasant way to wake up on a Monday morning. So yeah, this is, I think, a useful conversation. Brian, I'm sure you have a lot to add here for Jeff and everyone else out there who maybe is a little bit confused about how puts work. And as Jeff puts it, how this implementation of the exercise of put options works when you don't own the underlying, and if it's if it's affected by market conditions and brokerage policies.
Well, obviously, this was a very odd situation overall. I will say this, that if you're worried about being exercised on an option that you're in control of, you can call your brokerage firm and you can ask them to not auto exercise. But in most cases, if you have a situation where you are in the money on an option contract, in most cases, you want to exercise that option contract. So the brokerage firm will assume that and will exercise on your behalf. And that would be laid out in the account opening process when you sign up for option trading overall. But in this scenario, unless you called your broker and said, please do not auto exercise this position because it was in the money, they auto exercised on your behalf. And the biggest thing here was that you had that ability to be short that underlying stock. And when you are short that underlying stock, if you have that ability to do it, then that's going to cause more of an issue because there's no reason for them not to auto exercise or to try to stop that auto exercise that's going to happen at the Options Clearing Corporation. So overall, yeah, it's a real tough one on a situation like GameStop, and that goes all the way back to the initial question when we started this. Should this be considered one of the frenzies that we should add to the list? And on a one-off stock position, I definitely think that it should be, because that what has happened in that underlying has just been crazy, and it still continues to be crazy.
Yeah, I get what you're up to there, Jeff. You wanted to try to squeeze out a little bit extra. You should have closed it, and that's what we talk about all the time. But you wanted to get a little bit extra out. I get what you're going. You were kind of rolling the dice for it, but then exactly now you have this short position that you didn't plan on. So it's probably at the end of the day worth it just to take it off. Or as Brian said, take the extra step and actually contact your broker. Say, hey, if it goes in the money, don't get me short this thing. I don't want it. So yeah, that's an interesting lesson. I'm glad you shared that with us because that could definitely help other people out there who are maybe in your situation. And given how much the option space has exploded just in the past year and what percentage of those people are completely new to the world of options, I guarantee there's a lot of people out there who have a similar question to you there, Jeff. All right, let's see. Let's wrap it up here on a little bit of love as well. Let's go out here. Laxin15 chiming in, Brian. Laxin15 just wanted to say, you guys just put a smile on my face. Thank you. Well, thank you for that, Laxin15, and everyone else out there who took the time to join us live, to send in your questions, to write your comments, who tunes into the show every week. We love all of you folks out there. You guys really are the reason that we do this, after all. That's why we love doing. I even got Brian to do a live huddle just for you. That's how much we love you guys out there. All right. Unfortunately, Brian, that music means we've come to the end of this very rare live huddle. Let us know if you like this. If you'd like to see it here in Brian's voice live here on Education Wednesday. If you do, we'll see if we can squeeze him on a little bit more. If his compliance will let him loose a little bit to come chat with us live here. But Brian, if folks are enjoying this, maybe they want more, maybe they have more questions about puts or anything else out there, where should they go? What should they do, Brian?
Well, there's two ways that they can contact me. You can actually follow me on Twitter and see what we're doing in the educational front over at Ally Invest. My handle is very simple. It's @BrianOverby. And you can also email me directly at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for coming. Thanks for hosting, Mark. And until the next time, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.